Hello, everyone, and welcome to the Centurion September pre-recorded webinar with Greg Romundt, President of Centurion Asset Management and Portfolio Manager of the Centurion Apartment REIT. I am Paul Mayer, Head of Sales at Centurion. We thought we would tape this advisor webinar as a complement to Greg's recently published white paper titled "The Inflationary Regime Will Be Here for Years to Come," which is now available on our website. This webinar will draw on some of the content from the website, from the white paper, as well as touch upon some other topics relating to the Canadian multi-residential apartment sector and the Centurion Apartment REIT not addressed in last month's live advisor webinar. Today, Greg will add to his ongoing analysis of the inflationary economic landscape and of the state of the Canadian apartment sector, highlight some recent Q2 REIT metrics, and unveil a more streamlined asset management fee structure for Centurion's two funds. Greg, I know that the advisor community very much appreciates your accessibility and willingness to share your opinion on the many issues that affect the Centurion Apartment REIT. I guess first off, why did you think it was time to write a new white paper?
Well, it had been some time since I'd written the first white paper and the follow-up. And with much of the world seeing a decrease in inflation rates, many are saying that high interest rates have done their job, mission accomplished, and the specter of inflation is over, with all that entails. Within this context, I thought it was necessary to revisit and reaffirm my general thesis that, as the title encapsulates, the inflationary regime will be here for years to come. I've spoken in my many webcasts over the last 3 years that the inflation problem we currently have in Canada and the collective West more broadly won't be solved in the short term. In my August 13, 2020 paper, Regime Change Ahead, Why I've Changed My Core Thesis from Disinflation to Stagflation, I warned that we were leaving an era of disinflation, lowflation, and that inflation was coming and that it would stay. In my April 28, 2022 paper, The Regime Has Changed, I updated the thesis in part to respond to the start of the central bank interest rate increases and why these would make little difference to the inflationary trend that will play out over the course of the next decade. I also recognize that there's been much recent excitement and some concern, obviously, about generative AI and its potential deflationary effects. The economic impact of the technology was a theme, certainly in my prior decade-long thesis, from the end of the great financial crisis until about August of 2020, which argued that we'd be in a period of disinflation because of the gradual process of robotization and softwareization. However, today, while robotization and softwareization and now more generalized term AI may help us to contain some of these wage costs and ultimately production costs, it will likely result in mass unemployment requiring mass money printing in some form of universal basic income or UBI. Because governments seem to default every time to money printing, which will ultimately have an inflationary effect. Thus, despite these forces and the impact of high interest rates, I continue to argue that inflation is here to stay.
And would you care to quickly remind us of those big overarching factors which will keep inflation with us for some time?
Absolutely. I mean, the first thing is I would say, please do go and read my most recent paper and, refer back to some of the earlier papers for much more in-depth analysis and also lots of charts, which help demonstrate my point. But the first would be deglobalization. And much of this has been talked about reshoring, and which really does increase the demand for labor, which means all else equal, the labor market's going to stay tight and wages are going to rise. The world is continuing to deglobalize. This is everywhere in the news and in policy statements. Not only is the West distancing itself from China, Russia, and others, but witness also the rise of the BRICS Plus, whose goal is to isolate from the Western colonial domination. And globalization, having already stalled, has now gone into reverse. Second, if we think about rebuilding military readiness, the war in Ukraine has drained Western defense stockpiles, and these must be rebuilt. Not only this, but the peace dividend that came at the end of the last at the end of the last Cold War has now gone into reverse as the new Cold War has begun. National security will drive supply chains considerations, not efficiency nor price. And the requirement to reshore production after decades of offshoring via globalization will require very heavy capital expenditures akin to wartime spending. I mean, Canada, not Canada alone, has underinvested in its military for decades. And if we believe that the world is going into a less safe place, that means we not only need to restock what has been given away, we also have to rebuild and retool with a modernized military and catch up for decades of spending that was avoided. Next is commodities. And this is a theme I've been talking about for a while. Commodity prices are going through a regime change and will stay high, will rise and stay high for a long time, pushing inflation through the cost of food, energy, and goods. Energy reserves have been somewhat depleted to keep prices in check, and capacity for new supplies is not being built very much because of the ESG drives that I think are choking capital investment in this field. Which brings me to my next point, the green transition. This will no doubt be inflationary. Trillions upon trillions must be spent on this infrastructure. And where will this money come except from the printing press? Witnessed recently the EV battery plant subsidies that the Canadian and Ontario governments are spending to attract battery manufacturers to Ontario or Canada more generally. These wouldn't have happened if it wasn't for the printing press or money just being thrown at them. So if these projects were truly worthwhile, they would get built here anyway. They would get built anyway. But the only way that they make work is with money printed at the press of a finger. And next, we still talk about this work from home, and this is one of the causes of low productivity growth and permanently damage the labor market because resistance to return to the office is high. For those who argue that work from home is just as more productive than being in the office, I would point to the national productivity declines to levels below the start of COVID and down dramatically from early COVID time. Increasing productivity helps keep inflation in check and make everyone's life better. By contrast, work from home led to declines in productivity, which ultimately are going to be inflationary. China. This country is at risk of implosion. I've talked about China for many years now, and they've continued to bail themselves out by printing more money. And certainly, this is in the paper a lot today. And markets are somewhat undecided between, is China going to be a disinflationary, deflationary force because of their slowing economy and their debt bubble and their imploding real estate industry, or are they going to do the easy thing, which they've always done in the past, which every government in history has always done, which is just print their way out of it? China will never allow civil unrest and will choose money printing like every government in history. And that, while it might not happen today or tomorrow, is ultimately going to be the result. And it's going to see an inflationary flood out through the rest of the world. Next is very high worldwide debt levels. Central banks everywhere have given up the reins on monetary stimulus to politicians. And I called this out during COVID, that when our governments went and spent a tremendous amount of money, reckless amounts of money, and the central banks just printed the money to cover it. Budget deficits are out of control everywhere. Fiscal policy, in other words, government spending, is inflationary, and governments have shown no interest in becoming more responsible to reduce these pressures. Fiscal policy is running counter to monetary policy. That means the fiscal policy is pumping money in and monetary policy is pulling out, thus making the inflation problem resolution even more challenging. This is inflationary because too much money has been printed to finance these deficits, and government deficits and debts are exploding. Therefore, given very high debt levels, the central banks will have no choice but to let inflation run hot, no matter what they tell us or just claim in the paper. In the Canadian context, we've also seen very high rates of immigration, which are fueling demand because all of these people require housing, healthcare, food, and daily essentials, while we're choking the creation of supply for everything that we need, whether it's hospitals, whether it's factories, whether it's farm production, whether it's housing. All of this requires capital, and higher interest rates just choke the production of of those ultimate supplies.
Would then these be then the building blocks of a stagflationary future then?
Yes, I mean the classical response to inflation, which is what every high school kid learns in their economics class, has historically been to increase interest rates in response. In this cycle, however, this would make things worse, not better, as the problem isn't so much excess demand, but a shortage of supply driven by the previously discussed supply chain destruction, deglobalization, remilitarization, work from home policies that reduce productivity and the willingness to work, and excessive levels of immigration. So it's not so much that we're necessarily spending more per person, just there's now more people and all of them want to eat and all of them want houses. So they're spending. So it's not excess demand that's created by, I would say, um, the public at large, because there's just more of us. Interest rate hikes will only make the ultimate resolution to the inflation problem take longer. And you can't fix supply driven problems by choking the creation of supply. Choking demand is a very blunt, and it's what they talked about. Choking demand is a very blunt and short term tool that only creates serious pain. Interest rate levels at the levels they are at currently are not sustainable and are going to break things. Consumers, businesses, the housing market, the economy, and the governments eventually, mark my words. The US is already paying near $1 trillion a year in debt service, and over 50% of their federal debt matures within the next 2 years, which could send debt service and deficits into the stratosphere. Interest rates will have to fall in response, and this will stoke inflationary pressures mentioned before, at least in the short term, until our supply chains normalize. And this is, I think, the key. We need to rebuild the supply chains, and that's ultimately going to be at higher levels of price.
I guess the Canadian apartment sector seems to be the poster child of these stagflationary dynamics. That is to say, the inability of supply to meet staggering demand. Is there anything that you wish to add to your discussion of the imbalance in this sector, which you did not mention in last month's webinar?
Yeah, I think we're all familiar with the underlying dynamics of immigration and unaffordability of single family homes, fueling massive rental demand and the impact of high interest rates, NIMBYism, lack of construction trades, government fees and levies, and also slow approval and building times preventing the creation of much needed apartment supply. Long sentence, but I think everyone knows now. However, I should like to highlight again that the sheer size of this problem is just daunting. Canada's GDP is currently about 2.14 trillion in 2022 numbers. To restore affordability, CMHC, or Canada's housing um, uh, our housing authority, says we need about 6 million homes by 2030. That's about 3.5 more million homes that are projected to actually get built. And if the average house in Canada is, call it 710,000 and 500,000 for a condominium, and this means, assuming a 50-50 mix approximately, Canada needs about $3.6 trillion of investment to build this stock, assuming an average price of 4,000. That's 168% of GDP to be invested in 7 years. Good luck. I mean, I wish we could, but it's just impossible. If we assume the cost of a condo is a good proxy for an apartment and the rough mix of rental housing is 1/3 of the total housing, then this means we need about $1.2 trillion of capital in just 7 years. We assume about 1/3 is equity, then the purpose-built apartment industry requires $400 billion of capital to construct this stock. Given the total market capitalization of the entire Canadian public apartment REIT space is less than 20 billion. Where is the extra 400 billion going to come from in such a short period of time? And it certainly is not going to come from any level of governments who just don't have this money. There is no funding model that can build this amount of housing that is financially feasible given Canada's already high debt levels, large fiscal deficit, or that any governments at any level could tolerate for political purposes otherwise. Not to mention financial. Municipalities have little money. For example, Toronto is facing a budget shortfall of about $1.5 billion as it is before a recession, no less. And in 2022, Toronto increased its development charges, the tax the city charges for each unit that they create. The very opposite is of what's needed to make projects financially viable. So they're making it worse. So given the deficits, Toronto by itself, who couldn't fund this growth anyway by itself, can't afford to cut the fees to make construction more affordable. And with provincial and federal deficits, there's no way that they can make up for these changes. I mean, hopefully they can do some things around the edges, but removing these taxes would dramatically improve the economics of building. But how do they fund this? They're moving in the opposite direction of where they should be. It's thus up to the private sector to try and provide for this ever attractive supply shortage of apartments in Canada. But, where not everything pencils. So it's going to be very challenging.
And then what is that? What does this mean then for Centurion?
Look, I'd say apartments are going to be chronically undersupplied. This is what I've been talking about for years. This means, we own and manage a very sought after and desirable asset. According to the CMHC, the average increase in rental turnover in Canada was 18.3% last year. We've talked about this before. According to rentals.ca, average asking rents in Canada reach a record high almost of $2,100 in July, increasing just short of 9% annually. And our own portfolio, we saw our market rent gap increase at the fastest pace in history as we try to reflect market rents. So this bodes well for future portfolio growth. But as we point out in my most recent white paper, those rents really started to explode with the increase in interest rate policy, which is exactly what I said would happen. Make it harder for people to own, make it harder and more expensive to build, so less is going to get built. And of course, people can't afford homes, so they're going to have to rent. It's going to send rents up. So again, comes back to my earlier point. This is the wrong economic policy for alleviating supply chain problems or supply deficits. The large gap to market signifies an opportunity that rents are going to continue on their upward trend. The gap to market figure in dollar terms increased from 22 million at the end of last year to about 35 million at the end of June. So, this is one of the fastest rates of increase we've seen. Further, the market rate gap of properties owned more than 3 years is 17%, not the 8.5% for the overall portfolio. And the portfolio properties owned less than 3 years, the gap is only about 3%. But we think that that's less because those properties don't have a real gap that's bigger than that. It's just we haven't had time. It normally takes time for us to stabilize and for those communities to gain traction. And then once they're a go-to destination, we believe that we're going to see significant tightening of those rents as well. So it's our experience. The rents generally go faster and create market rent gaps once these properties are stabilized, which, we think will come soon, but it generally takes 12 months to 24 months at minimum. So we think both of those are going to trend in the right way.
And then would you like to take a moment to highlight a few more of the metrics from the REIT's Q2 quarterly report?
Yeah, absolutely. The rental revenue increased almost 27% in the quarter compared to the same quarter of the prior year, from 67.4 to 85.4 million, result of the number of acquisitions we made in 2022 and 2023, and the continued stabilization of these properties. Canadian stabilized apartments and stabilized student rents increased by 12.4 and 2.2% over the same period. And the trust same store metrics were also very strong. So operating revenues grew and NOI grew by 8% and 12% respectively on a same store basis. And the NOI margin increased by 2.3%. Furthermore, the same store average rent increased by 4.3%. And same store apartment 12-month operating revenues grew by 7.5% and 9.6%. And the average rent per apartment increased by 0.6% the same quarter last year. So keep tying well with inflation. The performance in the student book was very, very strong. 12-month operating revenues grew by 10.7% and NOI grew by 25.3% respectively. That's a same store basis. The NOI margin increased by 8.3% and the same store average rent increased as well. So very strong results that we're really quite pleased with.
I guess to end, Greg, you wanted to discuss a management fee structure change for Centurion's two funds.
Yeah. Well, since the inception of the REIT, the asset property management agreements have been updated regularly to be cost competitive and ensure continued alignment between the asset manager and investors. The last such revision was January of 2015. The current term of the asset management agreement would have ended about 16 months from today. So it's time to refresh and renew. The market standard for REIT asset management contracts has changed since our last revision almost 8.5 years ago. The asset manager and the board of trustees believed this was the right time to refresh the agreement and reflect current investment management trends ahead of the expiry of the current term. In connection with the updated asset management agreement, the asset manager will no longer be charging acquisition or transaction fees for mortgage or joint venture equity originations. The REIT and CFIT respectively will now earn those fees directly that were priorly retained by the asset manager. As well, the Class M units, which were confusing to a number of unit investors and advisors over time, are going away. We've converted them to A units, and there'll be no further entitlements or just dilution from those. So that's, I think, a cleanup of our structure that I think people appreciate. And against that, so there's no further dilution from that. And instead, the REIT will charge a 1% per annum asset management fee based on NAV and have a 50% performance incentive based over a 7.25 hurdle, subject to a full catch up and high watermark. And the asset manager will also be assuming all the asset management staffing and overhead costs. So the initial term of the updated agreement is 5 years and will be renewed automatically unless canceled. The contract is terminable by the REIT for poor performance of the asset manager at the end of the initial term, subject to unit holder approval, or for other strategic purposes after 7 years, subject to unit holder approval, and a 36-month make-whole payment on termination. The asset manager may terminate the contract at any time after the initial term with 180 days notice. Much thought and deliberation went into this change. A special committee of the independent trustees negotiated the revisions to the asset management agreement on behalf of the REIT and retained Davies, Wards, and Phillips and Raymond James as independent legal and financial advisors, respectively, to assist. The independent trustees, following receipt of independent legal and financial advice and considering numerous factors, including risks, benefits of the change to the asset management agreement, determined that the changes are in the best interest of the REIT and the unit holders and approved the entering into an updated asset management agreement. The asset manager, or my company, Centurion Asset Management, was advised by Sarah Global and Castles Rock, and the offering memorandum has been updated to reflect the change and posted to the website and to CDAR. And today, with assets over 6.7 billion, the asset manager and the board of trustees believe these modifications to the agreement will provide the REIT with an up-to-date, market-leading cost structure. The changes are also expected drive continued strong performance and are conducive to growing the REIT by attracting and retaining investor capital and management talent. Based on our review of our competitors, we believe that with these changes, the REIT will have the lowest cost, most transparent, simple, and aligned management fee structure of any similar fund in Canada.
Greg, thank you so much for this explanation. It was great to have this chat as we head into the autumn months. Thanks as always for your time and insights. Again, I would encourage everyone to access Greg's recent white paper. Again, it's titled "The Inflationary Regime Will Be Here for Years to Come." It can be found on our website. And again, it has even more in-depth analysis of the themes that we discussed in this webinar. Should you have any questions on any of the topics that we discussed, please do not hesitate to contact myself or your wholesaling teams. And with that, for all of us here at Centurion, thank you as always for your time and for your continued support. We wish you a very good day.